This week, we're reviewing the long-term returns of various asset classes and matching these two objectives. Cobie, run us through the scene setup for obviously the type of assets one can invest in.
We started off talking about again, the paper written by the Boston College of Social Welfare. And again, we kind of spoke about, kind of the stuff that parents need to do in order to ensure that they can leave responsible heirs, for the capital that they have. But understanding, once you actually get down to the nitty-gritty, it's about the different asset classes and how you behave with those asset classes and how they behave could potentially, impact on long-term portfolio returns. So have a look at your screen now. You'll see the rolling 12-month returns for various asset classes seen from a South African perspective. And you can see that South African equities are actually quite volatile. On a rolling 12-month basis, you could do as badly as minus 50%, but you could also do in excess of about 120%. If you look at South African bonds, those are far less volatile. South African cash, even less volatile. There's South African property. And it's interesting to see that the volatility in South African property, even though from a modeling perspective we'll kind of sometimes say that it's less volatile, you'll see that the volatility actually is shown to be quite high in South African listed property. International equities, you can see the volatility there in dollar terms, minus 50 and plus 50. And that's over time. That's obviously less volatile than what South African equities are. And there you can see international bonds on the other side. Obviously, you're not necessarily going to own asset classes, over rolling 12-month periods. Only over 12-month periods. You might own it over longer periods of time. Right. And that obviously makes a difference to this, Roland.
Yeah, I think if we're talking about intergenerational wealth, we are talking 20, 30, 40 years. And trying to maintain growth there is important. I think it's maybe a bit easier than trying to deliver wealth over a 12-month period because we don't know when what markets are going to do in the short run. But I do think what is very different about previous shows that we've been talking about in terms of asset allocation and risk management is that here we're talking about not necessarily a portfolio. It could be a bunch of property investments that the family holds. It could be a business, a brewery or a clothing factory or something like that, which has got a lot of wealth in it. But trying to manage that risk depends not on underlying asset classes, but things like what part of the economic cycle are you on? And economic cycles could take 20 years. So if you own a clothing manufacturing business and you have this big threat of Chinese imports, so your wealth that you have built up as a family could fritter away very quickly in the next 5 years if you close down because you got this massive competition from international kind of
So that begs the question, what are the questions you need to ask around the type of assets you have and then how to manage those assets? What do you advise to your clients?
Well, I think you've got to look at to make sure that your legacy is going to be sustainable. So clearly you have to make sure that you've got the right type of technical analysis, and there's a split between direct high-risk assets and high-root family assets and diversified assets. So you've got to do that. But the other key thing is, you've got to, the money is there for the people. And our money is there to work for us. It's not us to work for the money. So we've actually look at the people that actually this money is going to be supporting.
So who's managing the money? The personality of the person, of course, that has a big influence on how to manage the money going forward.
Absolutely. So if you had a big wealth transfer happening in a particular family, the assumption would be that they just want to carry on in the mining business. And maybe the children hate mining. But actually love hospitality. So you would need to take that into account. You wouldn't want to get all the money and put it all into hospitality because any particular business can have its own risks. So you want some diversified, but if you put it into hospitality, if one of the kids had a passion for that. So the personality of the person, for example, if you had a driver, someone that likes to control their own destiny, has a high energy level, give them a bottom line constraint and let them do what they need to do, and they will actually drive it. But if you've got a very amiable sister, for example, who will just float around and do whatever she wants to, then you need a different set of parameters for her under which you make capital available to her. Otherwise, that's not going to work for them. And if you do your strategy in line with who the people are, then they will self-propel, they'll be self-motivated, and your legacy will last.
What about when things get nasty? Because at the moment we're tracking one of the stories where Australians' wealthiest person with a value of around a net asset value of around $18 billion. Her name is Gina Reinhardt. She's gone to court with her three eldest children in terms of their trust fund, and they're alleging various things, and of course that will play out in the courts now in Australia. But it just indicates how things can get very acrimonious whilst you've still got, of course, both generations alive.
I would certainly like, and to all the parents out there, I would certainly like my kids to be in a position by the time they leave home and we've finished coaching them and training them, that they are able to live their lives without any money from us or anyone else. And I think if we get that right, then anything we give them becomes an enabler and a value add as opposed to a need. And that's I think is really important. You've got to get them off that financial teat to make sure they can do their own thing.
You see, I mean, I think it's a balancing act.
Yeah.
You've got various asset classes that show various volatilities over time. You can combine those asset classes and achieve objectives over rolling periods of time. But what you're trying to do is you're trying to match these and the financial objectives with personality types. And the personality types that you've got is all different for different individuals. And I mean, that becomes important. So if you've got clients that you know that are kind of in the driver's seat. And as a matter of fact, we've got a graphic on this. Why don't you look at your screen quickly, and you'll see the different personality types that you've got. And these are personality types and the strengths and the weaknesses that you get from those. You get the driver. That's the person who says get it done. The analytical individual who says get it right. Expressive, the bottom left-hand side of the corner, and then amiable, which means just get along. I mean, Ian, you've got some examples of clients that you've dealt with in these quadrants and how that kind of works with objective setting.
Sure, let's just be clear here, is that we do not do asset allocation at the share offshore exposure level based on personality. That would be wrong. So our diversified portfolio is left to the professionals like Roland. We'll pull them into the team and make sure that that kind of asset allocation is dealt with properly in the share selection. When we get into personalities, it really then drives down into what are the individual assets and what is the sort of the direct assets that we hold, and that's key. So the example would be, if you've got a driver that wants to control everything, and you tell him that he has to run this particular business, he'll take that business and he'll just turn it left at the next corner and turn it into something else and possibly make a failure of it because it's not his passion and it's not what he wants to do. So I think you've got to make sure that you can give him what he needs and what will actually motivate him, because if they're unmotivated, drivers will be distracted.
It's all coming back to creating that hunger, creating the understanding of the value of money. But Roland, let's bring it back to the type of assets one wants to be investing in right now. If you've got that 40-year horizon, you're looking to create wealth going on for many generations. What is your advice for parents right now in terms of asset allocation?
Well, I think you have to understand that there are two types of portfolios here. So if you only have physical assets, factories, some kind of mining exposure, something like that, you got to build a portfolio that offsets the potential risks that you are holding there. Whereas if your wealth is tied up in shares and bonds and is already a portfolio of liquid assets,
or more liquid assets,
more liquid assets. That requires much more of a professional kind of assistance where you get a wealth advisor to manage those assets for you over time and try and diversify them as much as possible. But it's the physical assets part that often is where the wealth lies, and only once the parents pass away, the kids say, what do we do with these things? Are we going to just sell them and use that money, or are we going to actually try and manage this? And this brings us back to the personality types. Are they interested in actually managing the wealth that their parents, or these assets that the parents left behind?
And of course, questions you have to ask whilst you're still alive and be able to manage the process of passing on the wealth to the next generation.